what the tariff wars has shown as well, the U.S. is not necessarily a safe haven for European kind of investment in a way. Is still the U.S., again, the most dynamic economy in the world, is a place where you have to invest it, but is not, I don't think we can say the U.S. is the safe haven that it was just a few years ago.
Hey everyone, welcome to another episode of WSJ's Take on the Week. I'm Telis Demos, and I'm joined this week by a special guest who actually sits about yay far from me in the newsroom.
I'm Hannah Erin Lang. I'm a markets reporter here at the Wall Street Journal.
Well, Hannah, welcome to Take on the Week.
Thanks.
And you joined for a very busy episode. We've got wild markets news, big stuff going on in the world. Economic data is back. We've been wondering when we can talk about it again,
right.
And now we can. Well, before we get into that, we want your help, audience, for our upcoming episodes. We want your questions, not only for our big Take on the Year episode, but also what should we be talking about in 2026? Think of some topics. Think of some things that you want answers on. We've got some big things happening next year. We're going to have probably more AI, not just in the stock market, but in the bond market, as we've been talking about. We've got, say, Federal Reserve Chair Jerome Powell. His term is ending as chair. I'm sure that will be big news. And what does that mean for the future of monetary policy in the United States? And then we've got, other things that help the market. We've got who's going to win the Super Bowl, for example, the AFC or the NFC. What will hemlines be? Hannah, I know you've got a big theory about pop music, right? And what that means for markets, what's going on in music?
Yeah, I've actually reported on it a couple times, but there's a sort of pop culture theory that when the economy is bad, the pop music gets really good. So who knows? Might depend on what's on the radio next year as well.
All right, well, we'll have to get the WSJ's music critics in here to tell us what's going to be popular in the music so we know what's going on in the markets. So send us your feedback at takeontheweek@wsj.com or drop a comment in your venue of choice. All right, in the here and now and the more prosaic, we've got a pretty interesting week for the AI trade. We started to see what I think a lot of people were calling the popping of the AI bubble, or at least the shrinking of the AI bubble.
This Nvidia earnings report was even more highly anticipated than other Nvidia earnings reports, which is already a kind of financial Super Bowl for the market. Based on what we saw when the chipmaker did report earnings, it seems like investors like what they see.
And actually, you had one interesting moment where Jensen Huang actually sort of used the word bubble. I don't know if you believe that, saying it kind of tempts fate, or if maybe you sort of kind of diffuse it by sort of saying the word. But he actually said, there's been a lot of talk about an AI bubble. Though he also said, from our vantage point, we see something very different. He said that he sees a virtuous cycle of AI, and he said that AI is doing everything, everywhere, all at once.
I think it was really interesting to see him address those concerns directly instead of maybe talk around it. And I think the question heading into the weeks to come is, if this report kind of puts the AI trade exactly back on track, are we going to sort of see more choppiness in the weeks ahead heading into the end of the year? We know that stocks tend to perform pretty well in the final weeks of the year, the so-called Santa Claus rally, if you will.
Yeah, I think it's hard to box the AI trade in just what does it mean for AI companies? Because with the amount of money that companies are spending on investing in data centers and other things, it's really an economic question as well for the broader U.S. economy. And so the question is, if AI is going to slow down, what does that mean for the rest of the market? And so I think that's why you saw really a pretty broad move in the markets over the last couple of weeks. You didn't just see AI falling, you saw all kinds of stocks. You even saw some things that have been doing well as a kind of risk protector trade, right? Gold was down. Bitcoin is down pretty significantly. So I think it's hard to just sort of isolate the AI trade from what people are thinking about in the rest of the economy.
One thing our colleagues at the Journal have reported on is this so-called wealth effect, where Americans sort of see their portfolios rising in value. Of course, that's broadly driven by the AI trade this year. And then, they feel better about kind of the wealth that they have, and they go out and spend more. What you've been seeing over the past year is that these the high-income or wealthy consumers are driving a bulk of that spending, while other working-class or middle-class Americans might be experiencing a very different economic reality. And it's it might be very well connected to how well the stock market has done this year.
Yeah, we got some interesting feedback to recent comments that we made on this podcast about this wealth effect, whether the rising stock market, which is really, in effect, rising AI stocks, they drive so much of what happens in the market, whether those stocks were making people feel richer and ready to spend. And a lot of people wrote to us, like in the comments of some of our videos, that we were a little out of touch to say that, right? They were surprised to hear that people might be feeling richer. And, one person said the top may be feeling richer, but the average person does not. Mm-hmm. And that's why I think what will also be interesting to look at, look, we've got some earnings coming up this week. We've got Dell Technologies, for example. That is a company that has in the past talked about how AI could be a driver of its business. So we'll continue to get reads on AI directly. In addition, we're getting a bunch of updates from retailers and consumer staples companies like J.M. Smuckers. They, of course, make a lot of things you find in the grocery store. And we've got a lot of retailers like Kohl's and Abercrombie and Fitch. We also just this past week had earnings from Target and Walmart. And while the headline number on Walmart was pretty good, an increase in same-store sales, I thought that some of their comments about what they were seeing under the hood were interesting. And what they said was that they were seeing a lot of increased market share. That is, people are coming from other stores to shop at Walmart. They were seeing some weakness starting to form in their lower income consumers, and they were seeing a bigger pickup from higher income consumers.
There's a lot of questions out there about the health of the U.S. consumer, and we're also heading into a season that is probably the most important for retailers and for a readout on how comfortable consumers are spending right now, which is the holiday shopping
Black
season.
Friday.
Yes,
coming
Black
up this
Friday. So, we won't get data from Walmart or Target right away on that, but we do typically get sort of third-party data providers telling us, how many shoppers sort of hit the store shelves and shopped online. And so I think that will be a really important gauge of how comfortable consumers feel spending right now. And again, how much of it sort of spans the income spectrum, because we've spent a lot of time talking about this idea of the K-shaped economy, right?
And K-shaped meaning some people are going up, some people are going down.
Exactly. And I think, to our commenter's point, this does mean that you can experience the economy extremely differently depending on, how much you make, how much you have in the stock market, the assets you own. And so I think I'll be watching this holiday shopping season to get a readout on, how much consumers are spending, because after all, this is sort of, the engine of the U.S. economy, and the health of the macroeconomic picture is something that myself and I know investors have been watching closely as we head into next year, especially when the job market is looking pretty fragile right now.
What's relevant for investors here is the question of if they feel like they need to escape the AI trade, right? If they feel like there's been a bubble, things have top ticked, that there's overbuilding, whatever their concern might be. We've talked about a lot of them on this show. Where can they hide? One place you might think to do is in consumer staples. Again, those are companies that sell stuff that people need to buy no matter what's going on.
What else could be a defensive play for investors?
Well, I think a big one that's already been playing out quite a bit this year is going global. When you look at the MSCI World Index, which includes the United States, as well as other markets around the world, the top stocks in that index are big AI companies because they are gigantic companies in the U.S. So just a global basket is basically a basket that's dominated by U.S. AI stocks. Mm-hmm. If you leave the U.S., if you look at the MSCI World ex-U.S. index, you get a very different mix of companies, right? You get big healthcare companies, you get oil and gas, you get banks. Those things make up a larger part of your investment basket. And while, of course, you can't totally hide from AI, there are many companies not only in the AI business, but that could benefit from it or be hurt by it outside the U.S. It's a trade that has worked quite well so far for investors who are worried about the U.S., not just from an AI perspective, but also might be thinking about dollar. We've talked about the dollar debasement trade here. We've talked about other concerns about the U.S. The U.S. is not just fiscal situation, but also the economy, politics, etc. So far this year, the S&P 500 index is up about 15% year to date, pretty good. The MSCI World ex-U.S. index is up 25%. The best defense is a good offense, right? And so that's how investors who've gone abroad in search of those returns have paid off so far. But It's hard to just say, do that, right? It's
Right.
not easy to just buy one thing that gets you the rest of the world. So the question is how investors should do that. So to answer that question, we had an interesting conversation earlier this week with Luca Paolin. He is the chief global strategist at Pictet Asset Management. They're based in Geneva, but serve investors all over the world. And we're going to have that conversation when we come back right after the break. Welcome back. We're joined by Luca Paolin. He is Pictet Asset Management's chief strategist, and we're going to talk about the outlook for global stocks for investors, particularly in the U.S., who are looking to diversify outside of their home market. So we know on this show that a lot of investors have been looking abroad lately. They've been diversifying their stock holdings to other markets. And we know that so far that trade has been doing pretty well. The MSCI World Index, excluding the U.S., has pretty significantly outperformed the S&P 500 so far this year. And a lot of that has been motivated by things happening right now. We're talking about tariffs, other political disruptions in the U.S. that might be derailing the U.S.'s economic outlook versus other countries. But Luca, I think you've got a longer-term perspective on this. You don't think this is just a 2025 kind of trade. Why is this a long-term move for investors to diversify outside of the U.S., where they've been so heavily overinvested the last few years?
I think there are a few reasons why we think investors should invest more of their money outside of the US. The most obvious one is related to risk management. You have now, if you look at the MSCI All Country Index, 64 to 65% of the index is in US stocks. Then obviously if you're in the US, there's maybe less of an issue, but if you're living in Europe or in Japan, a huge chunk of your, for example, your pension is linked to a country which is far away in a different currency, also relatively expensive. So there is an element of diversification that we have to take into consideration. The second point is that it's difficult for me to believe that the US economy will continue to outperform in the same way that it has done over the past 10 years.
I know one thing that was talked a lot about earlier this year was whether or not European countries might start to catch up to the U.S. in terms of fiscal spending and other borrowing. We've talked about the sort of investment in the European defense sector, for example. And I wonder if that's part of what Pictet has been writing about called the Great Convergence, where it seems like you're arguing that markets around the world are going to start to look a little bit more like each other. Tell us more about what this great convergence is. And does that mean that, European countries might start spending a little more and catching up to U.S. growth?
First of all, let me say that we are talking about convergence in terms of economic growth, economic policy, valuation as well, and also performance of asset markets. And you're totally right. Germany is moving from fiscal austerity to fiscal expansion. Now, the numbers are quite significant, but the most relevant aspect is the philosophical aspect of it. There is a significant change in the mindset of the German government. They realize that they are effectively not investing enough, not only in defense, but also in infrastructure and the rest. And they are effectively lagging behind the rest of the world. But that's not the only reason. This is one of the reasons why we expect this convergence to happen. Partly also because if you look outside of Europe, China is kind of stabilizing after a very, very difficult 5 years. And Japan slowly seems to be moving into a more business-friendly kind of environment. So it's not just Europe.
I do wonder, though, if tariffs are going to cause economic challenges in the United States, for example, how much of that does bleed over into global growth?
Well, I mean, there is no question that when you look at tariffs, first of all, that's a negative for everyone, because we tend to forget that tariffs are effectively taxes paid by US importers. So the US consumption share of GDP is 68. In China is 40, in Europe is 50. We need some kind of adjustment there, and tariffs will, in a way, create this kind of environment. If there is a slowdown in the US, everybody else will suffer. I feel, though, that the US has less room for fiscal expansion. And for that reason, if there is a slowdown, the US probably suffer more than the rest of the world.
So what if the U.S. does actually continue on a path of sort of fiscal expansionism as well as expansionist sort of monetary policy? Does that mean that the U.S. could outperform for at least some of the next 10 years?
No, I don't think so. I think if that's the case, let's say that the US administration will continue to run deficits close to 7%, and the Fed will be, let's say, inclined, forced to cut rates. I think the end game will be much higher inflation. So I think that this is what the US economic policy will be: more fiscal expansion, interest rate cuts. We call it fiscal dominance. I don't think it's going to be particularly bullish for stocks. I think it's going to be bad for the US. I think it's going to be definitely very bad for the dollar.
I'm glad you brought up the dollar, because when the US dollar weakens, that just reflexively increases the value of foreign earnings and foreign stock prices just in US dollar terms. And so how much of the outperformance of investments in Europe or Japan, other countries, for U.S. investors has been about the dollar and will continue to be about the dollar? I know we've all been talking about this idea of a debasement trade lately. Is that a part of the diversification thesis for U.S. investors for the next decade?
Absolutely, because when we look at the expected return in local currency terms, not a big difference between Europe and the rest of the world. The dollar, the weakness of the dollar, in our view, will continue. The conventional wisdom is that we can't predict the movements of currency. That's true in the short term, but in the long term, it's actually incredibly easy. If you just look at the performance of the Swiss franc has been basically in a secular uptrend in the past 30 or 40 years for a very simple reason, because we have almost the same growth of the US thanks to immigration. You have no inflation, primary budget surplus, current account surplus. And, that's why the currency is on a straight line upwards. If you look at the past, 5-10 years, the US growth has been very strong. But when we look at the next 5 to 10 years, we see inflation being actually higher than growth. And what is really important when we look at the performance of a currency is how strong the economy growth and how low or high inflation is. Higher inflation is bad for a currency. High growth is positive.
And conversely, what does that mean for non-U.S. investors? One big theme of U.S. exceptionalism for recent years has, of course, been money from other markets coming into the U.S. Are they also thinking about diversification, in part because they're going to benefit from the opposite of that dollar position, right? If the dollar weakens, they don't want to be holding dollar assets. So what are those conversations like?
Europeans tend to have a lot of private wealth invested in stock and bonds, obviously. And a lot of this is invested in passive forms, right? So when you invest in passive forms, let's say, and you buy an ETF, a global ETF, you end up, let's say for European investors, to have almost 70% of your wealth, not only in the US, but effectively in 10 stocks. They're all in the same sectors. So the concentration risk is significant. And, we are quite bullish still on AI teams, tech stocks. But there is an element of risk that we have to take into consideration. Also, there is another element I think that is important, is that when you look at the global, the macro outlook, again, there is this perception that it's becoming and is very, very risky. And what the trade war, the tariff wars has shown as well, the US is not necessarily a safe haven for European kind of investment in a way. Is still the US, again, the most dynamic economy in the world, is a place where you have to invest it, but is not, I don't think we can say the US is the safe haven that it was just a few years ago.
Luca, I want to talk a little bit more about the specifics of diversifying your U.S. stock investments. In the U.S., most people buy the S&P 500. I'm not sure exactly what people are thinking about when they talk about diversifying globally. Is that just the MSCI U.S. index, or should people be thinking about specific markets, particular stock markets where they should be buying that market's index? And what about other asset classes? Should those be diversifying too?
First of all, let me say that when you look now, and we have a lot of data on this, an average U.S. investor has roughly 70 or 75% invested in stocks. And I'm pretty sure that a good 80 or 90% of this is invested in the US. This is the starting point, partly because the US stock market has done so well, but also for other reasons, right? There are no obvious alternatives to the US. So now the point is this: when we talk about diversification, it's not only diversification away from US stocks. I think what investors could do, especially in the US, is to take some money out of US equities, let's say 10%, put part of this 10% in non-US equities, but also in bonds, especially corporate bonds and gold. So it's important to highlight that it's not just US equities against non-US equities. It's also to diversify across different asset classes, different regions.
But some markets do look like they've got some nice potential. In the 2025 outlook that Pictet published earlier this year, it listed the expected returns for a bunch of different markets. And for example, Japanese equities actually had the highest expected sort of average return over the next 5 years. Is there something particular about Japan for a US investor that looks attractive?
Japan is a typical market where I think the currency factor is going to be particularly important. The yen is cheap on almost any measure. The Bank of Japan is one of the few central banks that are hiking rates. Japanese, and that's really also very important, the Japanese market has been for 2 decades basically in a phase of deep deflation, and now it's back to normal. So Japan has become, in a way, investable again, cheap valuation, decent growth, but what makes all the difference is this significant undervaluation of the yen, which is basically due to the fact that interest rates in Japan are much lower than the US, but the gap will close. So again, I think is valuation, is growth, but also some pro-business reforms, more retail investors investing in Japanese stocks. But I have to say that a lot of this outperformance that we expect is going to come from the currency appreciation of the yen.
Emerging markets also rate pretty highly in some of those expected returns. I think the returns have been a little disappointing probably for some investors who bought them in their long-term portfolios over the last few years. Do you think emerging markets are poised to kind of regain that status as among the highest returning in the world for a dollar-based investor?
Yes, I think though emerging markets are not the emerging markets of the 90s, in a way they're safer bets. It's very difficult to put all emerging markets in one single pot. I mean, if you think about the difference between, for example, India, where we think there is massive potential. India is probably the only market in EM, big market, that you buy from a top-down perspective because of the growth that the Indian economy will generate. Then you have other markets, like, let's say, especially China, that to be addressed more from a bottom-up perspective, and others where Korea and Taiwan, they're very tech-oriented, which I think they will do very well. And then there are, of course, the turnaround story potentially in Brazil, in Latin America. So it's not an homogeneous kind of group of markets, but they share one thing, which is very important. They have superior growth. They have inflation, which is relative to a few years ago, pretty much under control. We see reforms in most of them. And critically, we are going to expect a much weaker dollar going forward, which of course will help emerging markets. Will emerging markets boom? No. Will emerging markets outperform, especially the US? Yes. And this, by the way, is true also for emerging market bonds, where we see, in fact, almost more potential than emerging market equities, because you have interest rate cuts, good valuation, inflation under control. So I think, yes, we are going to see a re-rating of emerging markets overall. But again, you have to be selective.
We've got one last question for Luca Paolin of Pictet Asset Management when we come back from a quick break. Welcome back. We've got one last question for Luca Paolin, and I know we try and keep this brief, but I've got kind of a big question here, because, and this is the thing that concerns me about the idea of international diversification, or maybe it's the main feature of it, depending on your point of view. So I just want to highlight, if you look at the MSCI World Index, which includes the U.S., the top 10 holdings in it are, at least when I looked at them very recently, were basically a list of AI heavyweights. Nvidia was the top one, followed by Apple, Microsoft, Amazon, Google was in there, Meta, etc. Right? So when you're buying the MSCI Global Index, you're buying something that's a little bit like the S&P 500 and that is very heavily AI weighted. When you're buying the MSCI U.S. index, you're getting way less of that. Some of the largest holdings are drug companies, food companies. There's a bank in there. So what I want to ask is, are you just kind of going short AI if you diversify out of the U.S.?
No, because we believe that AI is transformative. We believe that AI will boost productivity across all the economic areas. We do believe, though, that now we have seen the first wave of AI, when obviously you have all the tech companies benefiting from the first trend. But then the benefit of AI will spread out to industrials, utilities, because you need a lot of energies, materials. So once the AI kind of waves becomes more mature, many more companies will benefit from that. But also within AI, we do believe, for example, that Chinese tech company will also benefit massively from AI. So what we are actually doing, we don't think that the AI story will fade. We don't think there will be a crash in AI. We think that we are just at the beginning of something which is very transformative. We just don't think that the gain will happen only in 10 stocks and US stocks. I think that's the main story behind our sector out. We still believe that tech will outperform, but not just in the US. And again, AI will spread to other markets, other parts of the economy, and this boost to productivity. Everybody will, in a way, enjoy this. And I think markets that have been lagging will close the gap. And that's part of our convergence trade as well.
All right, so diversifying geographically is also diversifying the kind of AI bet you have. Interesting. Well, a ton for everyone to think about. Luca Paolin, thanks so much for joining us.
Thank you.
Okay, let me fix my I know my bangs are just K-shaped.